Hello, traders. Hope everybody's ready for a big week. There isn't a lot of news in the US market this week, but that doesn't mean we're not going to see big moves throughout the course of the week. I think we're going to see a lot of fluctuation and a lot of opportunity for shorter term traders, 4-hour traders, and 1-hour traders to really catch some big swings, both in the Forex market as well as the US stock market. And it's all based on what's going to happen in the US stock market. It's because there are many members of the Fed that are going to speak this week. They're scheduled speaking engagements, but they are not Fed meetings or policy decision statements or minutes or any of that stuff. It's none of the normal stuff that moves the markets. It's just the Fed guys talking. And here's the thing. Right now, everybody is expecting the Fed to raise interest rates by 3/4 of a point. So throughout this week, everyone's going to be parsing every letter of the speeches given by the various Fed directors that will speak, including Jerome Powell, at some point in the upcoming week. And as they do, their opinion on whether or not it'll be a 3/4 point rate hike or it'll be a 1/2 point rate hike will vary back and forth, and that will move the market up and down rapidly. So it's an excellent opportunity to set price targets and take your profits once they hit a certain point. I don't think it's a good week to play big, long trending, unless, of course, you're making trades based on a daily or weekly chart where you're sitting back and letting the trends fluctuate and run if they will. I believe that the 5-day forecast is bullish for the US stock market. And that means it is bullish for the euro and bearish for the US dollar. Let me show you from 3 different charts why I believe that's true. We're going to start with the S&P 500. I'm using SPY right here. And as you can see, we're making a significantly higher low. The second higher low and the first, significant one. We've got the lowest point put in back there in late June. And then you've got the more recent one that happened in the middle of July. And then you've got this one here that just occurred this past week. And so this series of higher lows also being, coincident with a series of higher highs says that the US stock market is in an upward trend. Real simple. You just want to follow the trend. The trend right now is bullish. And most important of all, we had a gap day on Friday. What should have been a quiet day without a lot of news, the US markets turned that into a big buying rally, starting with a gap up, and then it went higher and closed near the high. Days like this create about a 60% probability that the S&P 500 will end higher 20 days later than it closed on this day. So the odds tilt in the favor of continuing this bullish trend. Okay, that's chart number 1. To corroborate that, we need to get some sort of idea of whether or not people are improving or gaining an appetite for risk. We've been in a bear market in the US stock market for the past 6 months. Are we really ready to come out of that? In order to believe that, you'd have to believe that the US market was going to be filled with people who were willing to take on risk. Lo and behold, we have the Bitcoin chart. Bitcoin really suffered, came down strongly, but ever since that same point where the US stock market bottomed out, it has held a floor. And just in the past 3 days, it really lifted off that floor, trading in around 2,100. At the time of this recording, Bitcoin is the only live market, and it's not giving up its gains. So do we have an interest in taking on more risk? Yes, we do. Not a huge interest, but at least some, which is what you would have to see in order to believe that the stock market was likely to continue trending higher. A clearer indication, though, would come from the Aussie yen pair, AUDJPY pair. What is this Why is this important? Well, because the Aussie compared to the yen is the interest rate differential. Nowadays, it's even the U.S. yen, but I want to use a non-U.S. dollar pair, and this is the next closest thing. The interest rate differential allows large-scale investors to make money in the overnight carry of the Aussie yen, and so here it is. You have the Aussie yen breaking new highs. This is a good indicator of global risk appetite. Globally, not just in the US, people are willing to take on at least a little more risk, and that is evidenced by the fact that you see Aussie rising against the yen. And then, last of all, let's look specifically at the euro and the USD. Now, the USD, the dollar, has been gaining a lot of strength because people know that the Fed is going to be raising interest rates, and they have been. And as interest rates increase, of course, that makes holding US dollars a lot more attractive because you get the overnight carry interest being paid to you. And so let's look at the chart. Usually, you look at the Euro USD, right? But let's flip that. Let's look at the USD Euro, and you'll see something that I think is really important. And that is, this is the trend of the dollar against the euro, which, that's 60% of any index is the euro-US relationship. So the dollar is what it is most often in relation to the euro. Anyway, here we have this general trend upward. So now we're looking for evidence of whether or not this trend is continuing or weakening. If in fact it's continuing, then what you would expect to see is that the stock market should go down along with any other US dollar denominated pair. If the US dollar were continuing to strengthen, and this trend were continuing to go up, that's what you'd expect. All those other things, all the things you buy with dollars, to weaken. If the dollar weakens, then those trends reverse. So if the US stock market is going to be going up, it often will imply that the dollar is weakening in its trend and is about to go down, which of course means that the euro is about to go up, right? And therefore all euro denominated pairs would move similarly. Now, right here, I've just drawn these arcs, and it sort of helps you see what the dynamic of this trend has been so far. The US dollar, is making these moves that are the same time. These, I don't know if you can tell it, but these arcs are exactly the same shape. I drew this one, and then I just copied it forward twice. So it's surprising how the time frame of that first arc is mirrored in that second one. But look at how it compares in this third arc. Here we have this price failing to sort of hold up with it. Now, it's true that both of this one, the first time it didn't really go anywhere, and then it shot up. The second time it ran up, came back down, and then shot up again. But in both of those early moves right there, we're already well past that period of time. We've already had the up move, and we're heading back down. Yes, it could turn around and head back up. But see, it's already made these two significant peaks and is coming down and has taken out the low before it. That hasn't really happened before. I mean, you get something kind of like this, but you see how much stronger that looks. Or how about this one? It comes back down and it drifts, but it's like this is once, and it never comes back and challenges that low after making a peak. So instead here, we get this peak, we make another peak, and then once we take out the low, we trend down a little lower. So this thing here, we've made a higher high, it's true, but we've now gone and made a lower low. So I think that this is weakening, and I think the chances of it getting back up to the top of the arc and sort of completing this dynamic are decreased. What that means is you've got fewer and fewer people that feel like they want to be buying and holding US dollars. That's the key. The 3/4 of a point move that the Fed is expected to make is already priced in. And therefore, through the coming week, as the idea changes about whether it's a 3/4 move or a half point move, then you'll see this fluctuate. And once See, if they're not going to keep it at 3/4, if they're not going to keep raising and raising interest rates, then the U.S. dollar is going to peak and curl backward. And if in fact the Fed says, "Oh, you know what, we can't kill inflation. We've got to, we can't kill the economy. We're trying to get rid of inflation, but we can't kill the economy in the process. So we got to back off a little bit, and we're going to back off to just 1/2 point instead of 3/4." If they were to do a thing like that, the U.S. dollar would drop significantly because the 3/4 point is already priced in. And so I think that we could see throughout this week an inkling that somehow the dollar is topped, and that will add tailwind to both the euro and the euro pairs and the US stock market. So that's the outlook for the coming 5 days, and hope that is useful to you. Everyone, take care and trade well.